Well, good morning, everyone. It's 10 a.m. here in Seattle, Washington, and I am really pleased to be here virtually with you to introduce a neat panel of folks who know a lot about a topic that the world needs to be speaking about much more urgently and in much more depth starting now. So as a background about me, I'm a visiting professor of finance at the University of Washington in Seattle, and as recently was 7 years at Imperial College. My background is in the area of climate change policy and finance. And I think that this topic is so prescient because we are at a moment, I think, a real inflection point in the people's general understanding of how deep we are into the climate problem. And that now extends to seeing a number of challenges around net zero targets, a number of challenges around decarbonization at the pace that is required, and a recognition that even with those heroic efforts, which are absolutely necessary, we are still going to be living with very significant climate change on both a regional and a global scale over the next decades. And beginning to prepare for that now is not philanthropy, it's enlightened self-interest. And it's something that governments will need to lead, but the private sector will need to increasingly find ways into, because this divide around adaptation has always been a very challenging one in which it has been seen as exclusively the domain of governments, as a public good. And so there's always been a basic question of what does the private sector and what do capital markets have to do with that at all? And so hopefully over the next hour, we can work with that tension, hear some perspectives on folks who are trying to bridge that divide, and certainly get involved with your questions. And I always find these things are a lot more interesting as they become interactive. So that'll be our guiding belief as we go forward. So with that, let me ask the panelists to introduce themselves. And Alex, if I could begin with you.
Excellent. Well, thank you so very much. I'm really pleased to join this morning, noon, evening discussion alongside this distinguished panel, fellow panelists. Thank you very much to the Conduit and its 2.0 and ever better, I'm sure, version of itself for bringing us all together for what promises to be, as you've just said to us, Charles, a really engaging and timely and frankly urgent conversation about what can be done to accelerate global progress in not just, we're not going to talk so much about mitigating climate change, but about helping the most vulnerable of our fellow citizens of the planet Earth to adapt and be resilient in the face of this change. I'm Alex, as I said, I'm the CEO of the Global Innovation Fund, or GIF for short. We are an independent hybrid investment vehicle that focuses on social impact first and financial returns as a means to that end. Our mission is to accelerate innovation that improves the lives of poor people using debt, equity, and grant finance to back ideas that come from all over the world. During the past year, we've spent a lot of time thinking, as well as consulting externally with our government partners and climate experts, exactly what should be the role of an innovation fund like ours at this nexus of innovation and climate change. The feedback that we've heard, and I welcome this conversation today in this regard, is to focus on innovation for adaptation and innovation for resilience. So we're actively looking for mission-aligned partners that can help us to do that and do that thoughtfully. Since our launch in 2013, GIF's invested in more than 50 innovations throughout the developing world in things like education, safe migration, sustainable water and sanitation, and domestic resource mobilization. We think we're on track to improve the lives of 130 million people in the next 10 years on an annual basis. And we're excited to take our approach and apply it specifically to this challenge of our time, climate change. And it's our game to be additional rather than duplicative with others who are doing important work in this space already as well. So thank you, and I look forward to our conversation.
Right, thank you, Alex. Andrea, could I ask you to introduce yourself?
Yes, thank you. First of all, it's a pleasure to be here. Thank you, everyone, for the invitation and with a chance to talk about such a pressing and important topic. So I'm Andrea Alvarez. I currently lead the functions of brand, innovation, international, and sustainability for Natura. Natura is a Brazilian-based company founded in 1969 and is currently present in 10 countries, has 2 million consultants or beauty consultants connected to its 600 company-owned stores. And over the past years has become a part of what we're calling the Natura & Co group, which in 2016 acquired Aesop, an Australian-based brand. In 2017, The Body Shop, a British brand, and in 2020, Avon. And when we became the 4th largest pure beauty play group in the world, present in 110 countries, 3,700 stores worldwide, 8 million representatives and consultants spread across the world. So, but I guess the most important thing of this all is that we really believe that we should use all of these assets to nurture relationships and to build a better world. And we've been on that journey since this company started in Brazil 50 years ago, where we clearly understood the idea of interdependence, that we are part of a broader whole, that our actions have impacts and that we have to be responsible for them. So last year as a group, we announced our commitment to life ambitions for 2030, where we've set the ambition to become net zero by 2030 as a group, to protect the Amazon forest, to safeguard human rights and be more humankind, and to work towards circularity and regeneration. So that is what we're currently working against as a group. And we've also become the largest B Corp in the world after these acquisitions. So very happy to be here and very, very happy to expand on these topics over the next hour.
Great, thank you very much. Nate, could I ask you to introduce yourself?
Thank you very much. And yes, echoing the pleas, very happy to be here as well. And actually, I was at the Conduit today for lunch, so it's great to be back in the building and see 2.0 up and running, which is wonderful. So I hope many of you will also, I'll see many of you there over the coming weeks. I'm the CEO of the Global Resilience Partnership. We're a partnership, a diverse partnership of over 60 public and private organizations working on building resilience, primarily in the Sahel, Horn of Africa, South and Southeast Asia, although we do increasing work in the Caribbean and the Pacific on coastal resilience as well. We work across 4 interlinked areas that simply put as innovate, share, convene, and advance. And our innovate work is focused primarily on surfacing and scaling early stage innovations on resilience. We've supported over 7 million people in over 1,300 organizations, about 100,000 hectares of land to become more resilient. We, in our share work, we act as a knowledge broker, really sharing best practice on key things like how to measure resilience and how to implement resilience. We have a resilience solutions platform and other things which really amplify this and connect a much broader group of stakeholders than our partnership itself. Our convene work, we are the managing partner of the Resilience Hub at the COP, so that's related to this as part of the road to the COP. And that will be the key focal point for all resilience activities at the COP and really provide a window as well, a key virtual window into resilience satellite hubs that we'll have. And then our advanced work is we work with key thought leaders from the global south and the north on advancing resilience thinking. And we're really excited about that work as well. So hopefully be able to share some of that today. Very much looking forward to the discussion.
Super. Okay, good. So that's, now you know everybody. As I said, if you could go ahead for the participants that we have, and I see I've looked through them, several people I recognize and a lot of knowledgeable folks. So we very much hope this is a discussion amongst a group of individuals, clearly with a lot of experience on this panel, but as well, a lot of experience for those of you tuning in. So really look forward to your questions, so you can put in the chat or the Q&A, and I'll try and draw on them. I do have a few questions to ask myself to get us started. And so let me kick off with that. And Alex, if you don't mind, I'm going to come to you first. And I'm curious about innovation, because innovation, it goes right in the title of what you're doing, an innovation fund. That all sounds quite nice, but it's probably one of those very overused words, innovation. And so could you tell us what exactly does that mean in terms of improving livelihoods or in terms of climate change? What break down that sort of amorphous topic of innovation for us.
You're absolutely right. And it's a good challenge that, that word innovation, we throw it around, and with entrepreneurship, suddenly you don't know what either one of those things really mean anymore. I will say just broadly at GIF, we think of innovation in a quite broad sense. So we are not limiting ourselves to thinking about technology, but we are thinking about behavior change, regulatory reform, new ways for systems to work that can lead to more effective and cost-effective ways of solving problems. So we sort of think about development, and I think that this goes to our resilience question as well, as having a couple of big outcomes that we're driving for. Making public services work for poor people. And so what's the class of innovations that make public services valuable for everyone? Development's not just about increasing the number of dollars that are in people's pockets, because we could do that today with just purely ODA flows and lift people out of $2 a day poverty. But lifting people out of $2 a day poverty isn't shared prosperity, and it isn't resilience. You also need public services that work for everybody. The second thing that we need are markets that work to provide productive, dignified jobs. And here again, we'll come around to exactly this livelihoods question. And you see this interlinkage between what we mean by resilience and what we mean by, our goals around shared prosperity more generally. The third and final thing we emphasize at GIF is agency for women and girls, that women and girls are the protagonists in their own stories. And this is going to be critically important, we believe, for the resiliency agenda, that when droughts happen today, women and girls suffer more. And that costs that accrue to women and girls passes on through generations. That's not going to be acceptable when we're trying to think about people on the move responding to climate change. And we need women who can think for themselves, make choices, make smart decisions in a world that's going to be changing quickly and in ways it's very hard for us to predict. So we think that there's this real interlocking between an agenda around livelihoods, but also around foundational elements of resilience that are really going to help us get to shared prosperity and advance this resiliency agenda.
So I'm curious, let me ask you in just a second about maybe lay out some of these as specific opportunities, because I think for everybody who's probably on this, we're all looking for what's the way in, what's the way that my work or my interest can kind of find resonance with what you're doing. And so I thought you could just break that down for us a little bit and give us some examples.
Absolutely. So first, just to back up a little bit, and Nate probably could speak to this even more than I can, we should begin by noting that adaptation is neglected in the global finance landscape. So according to the Climate Policy Initiative, something like $500 billion a year goes to mitigation, renewables, and something like $30 billion goes to adaptation. Only a fraction of that $30 billion goes to developing countries, and a fraction of that for adaptation innovation. We think that the need in developing countries alone is something like $365 billion per year. So there's lots of opportunities for finance. One of the things that, as I said to you earlier, we're particularly interested ourselves in some of these foundational elements of resilience. But we're certainly sector agnostic, and I would encourage all of you here to be so, that instead of sitting in your office in London or Seattle and saying, what do I think is the theory of change in the world and how do I need to make it happen, to be very open to entrepreneurs and ideas that come sort of from the bottom up, and then challenging ourselves as funders to say, how can we support you to generate evidence of impact and pivot your way to an interesting and resilient business model? So take one example very specifically, social safety nets. We know that life for poor people is precarious. Bad luck and illness can tumble households back into poverty. So safety nets and making them work efficiently, like government cash transfers and private remittances, can protect households and communities. There's a lot of potential to adapt that for climate resilience. Another example is fecal sludge management and wastewater treatment. I've recently seen some evidence that suggests that something like 50% of the CO2 emissions in the city of Kampala come from sanitation and sanitation management. We have the opportunity to make cities more resilient by figuring out how to make non-sewered sanitation work as an effective business model, and at the same time reduce emissions. It's both an adaptation play because sustainable urban sanitation reduces water usage in places where water is scarce, and a mitigation play by potentially reducing CO2 emissions. So we're very keen on understanding what business models are going to work for sustainable urban sanitation as another concrete example.
That's great. So, I love the use of the word business model there, because, a lot of what you're talking about, and maybe just as we go forward in this conversation, the business model for a lot of services which would be captured under adaptation and resilience there's basically just one, which is a taxpayer funded business model. And so, countries that are higher in wealth, have a bigger tax base, are usually better able to provide the services that their citizens need. So as we stretch towards lower income countries, where that tax base doesn't support those activities, the question becomes, how do we crowd in other forms of capital, and how do we make sure that return on capital is both sufficient to attract them, but not fleecing them? And this is where it gets quite tricky. So I think it's a good moment to bring in a corporate perspective. So Andrea, if you don't mind that I turn to you, and maybe you could just start with an overview of this topic. And there's a lot of communities that you interact with, both in the supply of the materials and also obviously the consumption of the materials. And maybe you could just give us an overview of how this agenda is taking shape in those communities.
Oh, absolutely. And I really loved what Alex said about us looking at solutions that come from the bottom up and from unexpected places, because if there is, to me, in my view anyway, if there are solutions out there, they're probably not going to come from the places that generated the problems we are in now. So, and they should be also brought up by the people who actually experience the problems at their worst, because they're the ones that can probably find out what the solutions are for those things to actually come to fruition, and for us to find alternative pathways. And I loved that you touched on business models, because to me, that's also a huge mindset shift, where we think and design business models that have value distributive designs in them, and not value concentration or value concentrated designs, or concentrated models that are very hard to change if they are born with value concentration mindset or scale mindset, and that they're not decentralized. Now, the good thing is distributive models tend to be a lot more resilient. They're more complex. They're harder to implement, but they're extremely resilient. And that's where I'll bring in the Natura experience. We've been in the Amazon region for over 20 years now, working with access to biodiversity, genetic material, or cultural heritage, have been using mechanisms of value transfer through access benefit sharing. And the business model that has been designed on a decentralized model. So we currently work with 7,000 families in the Amazon region, in 11 different hubs within the Brazilian Amazon. We're now expanding to the Pan-Amazonian region. That's a lot of people. That's like 28,000 people that are sourcing the patawa product, or the kumaru, or the castanha ingredient, that then is converted into outstanding performing cosmetics that are then sold through a network of 2 million people. Now, getting that logistics right, getting that complex system to work is immensely challenging, but extremely resilient. And for us has been very successful, extremely successful, including in profitability and in margins. So it is a question of the design of the models that we implement, and then finding the ways to operate these models with excellence over time. But it is a mindset change, significant one.
So let me follow up on that, and if you don't mind, let's go to that issue of the Amazon, which for a lot of us who don't understand Brazil very well, and just see what we see in the newspapers, and maybe you could give us a bit of an insider's perspective on what your firm's commitment has been there, and what you see as some of the challenges associated with bringing greater resilience to that region.
Absolutely. Well, like I said, we've been there since 1998, so over 20 years. And I think the most important, and the Amazon region right now, for those who don't know it, it covers a vast majority of the Brazilian geography, over 65%. If you consider the legal Amazon, it's actually even further than that. This is a biome that spreads across 9 different other countries in Latin America, home to the largest biodiverse environments and ecosystems in the world, that is suffering from consistent deforestation, from economic pressures that come from very different reasons, which I won't get into right now. But anyway, so, and we've been operating there for over 22 years. And I think the biggest challenge for us was to actually have the humility, the sufficient humility to understand that whatever business model we were going to develop had to be co-created with the people that are in that ecosystem, and that we created a business model that would actually give back to that region, not only in terms of economic development, but also social and human impact. So we've been measuring those indicators over time: environmental resilience as well as social progress. And we've created a mechanism of strengthening of institutional territories, where with the people in the region, not only do we define the sourcing program and how much they're going to source of a specific ingredient for us, but also with the money and the revenue that comes from that value that is created, plus the access benefit sharing, how they're going to actually invest in that region as a way to make that place more resilient. What do we have in terms of results? We have 2 million hectares of forest that have been conserved over the last years, directly related to this. We've got deforestation levels that are 1/10 of what they are in surrounding regions, considering the regions where we operate. And so what we're doing there now is we've doubled our bet for the Commitment to Life ambition. We've said that we've publicly stated that we're gonna work on a movement that halts deforestation by 2025. Very aggressive ambition, I would say, given the current scenario we have there right now. We're gonna increase our protected areas from 2 million to 3. We're gonna go from 40 bioingredients to 55 bioingredients, from 7,000 families to 13,000 families. And that's part of our job, which is doing the business and expanding it. Now, we're also harnessing financial investments for different projects that we have in the region, such as the agroforestry palm and other projects that are based on bioeconomy.
Great. That's really nice, and a really kind of down on the ground perspective. I really appreciate that. Thank you. Nate, let me come to you next, and maybe to provide a little tension in the conversation, which hopefully at a creative level is always nice. There is a lot of virtue in bottom-up solutions. The flip side of that is that they tend not then to be scalable. And when somebody comes in and says, look, how do I put a lot of money against this? It's kind of bitty example here and small example there, and it just doesn't happen. So maybe you could, I know you've worked a lot in this area of nature-based solutions, and maybe you could speak to these barriers of scale and what we can do now about that problem.
Absolutely. Thanks, Charles. And first, I just want to thank Alex and Andrea for the comments about the bottom-up solutions, because I do think the push for locally led adaptation is gaining momentum, and it is absolutely the way that we need to go. But it does need to, I guess, be combined with working with the private sector and sort of engaging with these top-down processes as well. But it's wonderful to hear the fantastic examples of the local adaptation. I would say that when we're talking about nature-based solutions, I think we've been exposed to the importance of these, through the pandemic, and also it's exposed, really how fragile the gains that we've made over the last few decades have been. So just in the last year, we've seen over 120 million more people facing hunger in 2020 as opposed to 2019. We've got, and then, thinking out a little bit further, we've got these really scary statistics, 800 million more people at risk of storm surges from extreme weather by 2050, coastal floods and storm surges currently costing about 10 billion a year, but rising up to about $1 trillion a year by 2050 in terms of coastal cities. So there's some really big challenges ahead. And there's a pretty strong argument that the 17 to 19 trillion we've spent on recovery from COVID isn't building resilience to these future challenges. And I think nature-based solutions provide a real opportunity to do this. They do have to have the combination of working with the local communities from the outset. I mean, that is critical. But we really need to think about how to invest in these now. And if we want to sort of survive in terms of our economies and cities, we have to move at speed and at scale as well. So some of the key barriers that we've seen across the public or the private sector that we work with really relate to a lack of understanding about how investing in resilience and adaptation, nature-based solutions more broadly, can provide that timely and productive return. A limited pipeline of risk-adjusted investable projects to attract financing, insufficient data and modeling capabilities, and also inadequate enabling policies. But we are really seeing a shift now. And I would argue that 5 years ago, a lot of the discussion around nature-based solutions was primarily sort of faith-based, in that a lot of people knew that it was important to invest in nature-based solutions, but they couldn't really provide a lot of the data to demonstrate the business case for investing in them. And I think that's really starting to change. We're seeing, although Alex mentioned the lack of climate finance into resilience. And if we think about it in nature-based solutions, it's only about 3 to 8% of climate finance finding its way into nature. So that's about 90 billion a year over the last decade, which is not a lot. But we know, for example, that mangroves, for example, sequester 5 to 10 times more carbon than terrestrial forests, but they also provide about 80 billion a year in avoided losses from coastal flooding. And if the UN estimated that if we invest, I think, about 6 billion a year in nature-based disaster risk management measures, it would save the world about 360 billion over the next 15 years. So there's a lot being done on this business case on investing in nature-based solutions. And increasingly so, we're also finding that nature-based solutions are kind of this sweet spot that bring together resilience and adaptation with mitigation. So you're getting the benefits of carbon sequestration, but you're also getting key livelihood benefits and resilience benefits that are coming in there.
One of the things I saw this week in the news that I was heartened by is the announcement that the New York Stock Exchange is working on these natural asset companies with a small provider. Now, it's just one example, but it really speaks to me about one of the biggest opportunities we've got going forward, which is to find these bridges into mainstream capital markets. So I wonder if you could just tell me a little bit about this, if we're going to have an asset class, and we're a long, long way from there, but if we're going to have at some point in the future an asset class, you can even imagine an asset class in adaptation resilience that certain types of asset owners are obligated to hold, perhaps in compensation for their impact on the climate, then what's going to be necessary is some kind of asset pricing framework, and clearly to know at what price do I buy and sell these securities, all the things that we like to do for other types of financial claims. So I wonder, where are we in the trajectory of measurement around adaptation and resilience that could actually become part of that building blocks towards let's say a capital markets framework for increasing scale in these investments?
Great. Yeah, thanks. I think you're talking about the intrinsic exchange group that you might have heard about, which is great to see that. And I really hope they're going to have an exciting announcement around the COP in partnership with the New York Stock Exchange on that asset class. But touching on your question on measurement, so I think this is a real challenge, but I think we're starting to rise to it. Mitigation is really easy in comparison to resilience and adaptation in terms of measurement. We're looking at net zero. I mean, even communicating it is a lot easier. So for investors, the pushing into the mitigation side, I think, has been a sort of natural flow of capital, just because it's a lot easier to measure those returns. But there is quite a bit, while challenges remain, there's quite a bit being done, especially in the area of technology. So thinking about how we can see the role of big data analytics, unlocking new insights into resilience dynamics, especially in post-disaster tech contexts. So there's some interesting work done by colleagues at LSE and others in Myanmar, using mobile phone panel surveys to provide real-time updates. And there's a lot of opportunities, I think, also coming out from machine learning and looking at better predictors of resilience and highlighting hotspots of vulnerability and risk. And probably many in the audience are familiar with those risk index and predictors that are being out there. I would say that insurance companies are really leading the way. So we do a lot of work with AXA. They're really on the front foot of this. And many other insurance companies, Swiss Re, but also the finance industry is really coming in. Assigning the value to nature is always going to be a challenge, but but it is, as I say, it is increasing, and there's always going to be controversy around it. But I think it's definitely improving. I would just add, secondly, that touching back on the point on locally the adaptation that has been raised and highlighted. I think the measurement also really needs to meet the needs of not just of the investors, but also of the people on the ground. And sometimes we lean too far into aiming to meet the needs of investors. So there needs to be that focus of people on the ground as well.
Good.
Can I just build on what Nate said there very quickly, Charles?
Please. Yeah.
Which is, I think we are going to need a lot more vehicles that are comfortable with blended finance models as another place of where we're going to take some of these business models from good ideas to going to scale. And so vehicles in which, we're much more comfortable that there's some investors whose mandate is to take a subordinate debt position or to take a local currency position in a debt stack to crowd in dollar denominated finance on top of that. That's part of what GIF's mandate is, just as an example. And that means that we're in the business of crowding in capital, not crowding it out. If we can encourage the DFIs and others to also think about expanding their mandate in that space, that'll unlock more capital as well that can then help to crowd in some of the more commercial money that's on the sidelines that you guys have been talking about.
It's a really important point. We did a discussion paper 6 months ago on green finance and emerging markets, and one of the highlights of that is it didn't come out of any sophisticated empirical work, but it's to just observe that a lot of the money that flows into emerging markets on the debt side today is index driven and very passive. And so that's just to ask somebody to, even in the most perfect package in terms of size and expected volatility and everything, asking people to move back into the active space is really tricky. There are some specialists who do it, but by and large, that fixed income, particularly on the international side, is extremely passive and index driven, and that's something that needs to be looked at, because we'll exhaust those investors that you mentioned, and to get to the bigger amounts of money, we're going to have to break in somehow into that other share. Good. Let's move in. It's grateful to see questions coming in. And Andrea, a good one for you right off the bat. And let me just say is, because this is to frame a little bit the question that's been put there. This is certainly not just about your company. And if you think about, prosperity over the last 100 years, there has been an increasing flow of food. There's been an increasing flow of materials, and there's been an increasing flow of energy. And those have all underpinned the prosperity that has taken hundreds of millions of people out of poverty in this century. So, the thing that we're talking about here is somehow moving to another level of prosperity, but without increasing all of those flows. And a lot of historians would say, well, geez, we've never seen that, and that's just not possible. So I wonder if you could kind of address what kind of things you're looking at that somehow accomplish those aims without relying upon the classic models of increased energy, increased materials, and increasing land use.
I don't know that I have an answer. If I did, I would probably be selling it to someone, but I'll share what we have in terms of our thought process and the dilemmas we face, because some of these questions, they are dilemmas right now, but they have also, over time, social and environmental challenges for us have been an enormous source of innovation. And that's how we've looked at them. So when we look at these challenges and when we find the solutions to them, we usually find solutions that are very unique and very differentiating. Going to the Amazon 25 years ago was definitely not a simple decision to make. And right now, it's probably one of the most differentiating aspects of the business model that we have and of its value. So the long-term view is also something that helps, no? And looking at a longer term period and you know, raising our eyes to the landscape and not just looking at the current moment that we're living or the challenges we're living now. But we have definitely to move and change the consumption models that we as a society have so much fostered over the last 50 years. That has to change. That doesn't mean that quality of life has to lower. It just has to maybe be more equal or more balanced or produced in a way that emits less or through technologies that can actually be carbon positive. So in the way that we're doing this, and we've pledged net zero by 2030, and we don't have the answers to how we're going to get there. We've got some of the answers, but we don't have all of the answers. But we're currently doing the modeling of the different scenarios, and we're submitting to the Science-Based Target Initiative what that would look like in terms of how much we need to reduce in terms of emission, and then what we would compensate, if we would compensate, and how we would compensate. Natura as a company has been a carbon neutral company since 2007 with a carbon program that has reduction, elimination, and compensation at the core of its design. We need to take it another step. And so we're looking at all sorts of solutions, all the way from carbon positive technologies that are methane conversion into biodegradable polymers, to nature-based solutions such as the agroforestry palm oil project that we have in the Amazon that is actually even more productive than monoculture carbon, palm, and is absolutely impressive. Now we need to scale it. So we need to make it become part of the answer. Now, that also goes through elimination of things, evolution of our product portfolio, reduction of the product portfolio, different alternatives to shipping. I mean, we measure our carbon emission, and all of the executives at Natura have been compensated by a triple bottom line indicator dashboard for a very long time. So we are all compensated, not just on EBITDA, but also on carbon emission. And this has been forever, for more than 10, 15 years. We published our ePNL in 2015, 2016, and now we're just finishing our model for the social P&L, and we're going to have an integrated P&L to publish, which has been an enormous effort where we're actually really attributing value to the non-financial aspects of the business, but applying a return on investment on those indicators as well. And we think that that's what's gonna help guide us in finding the solutions we need, by looking at a more systemic approach, not just one monovariable aspect of performance.
That's super. Thanks a lot. Very glad that you would take that question on, because it was a tough one. Maybe the next question here, both Nate and Alex, I could invite you to comment on this, because it's also for me quite a challenging thing to get my head around this idea of what's risk appetite in this space. Now, if that was a question about publicly listed equities, I'd have no problem with that. But when I think about something that inherently relies on this tension between public-private, and sometimes, as you said, Alex, actually explicitly blends public and private, how should we be thinking about this idea of risk appetite, and who are those investors, and how does risk appetite change amongst the various investors who have already expressed their interest in getting more involved in this space? Maybe Nate, I'll start with you, and then Alex, if you wouldn't mind to come in after that.
Thanks. I think it's an interesting question, and I think answering it today is very different than answering it a few years ago as well. So I think COVID has changed things, and it's really shown sort of the interconnectedness of risk across our hyper-connected world. And I would say risk appetite is still not sufficient, I would say, from the private sector, but there is a lot of opportunity, as Alex mentioned, on the blended finance. So there's a lot of opportunity for governments and others to put in that first loss capital and increasing interest from the private sector on investing in resilience and adaptation, and an increasing risk appetite to do so. There's a lot of push to really surface those new ideas and build that pipeline as well, which is exciting, but also then looking for, what is scalable within that risk or within the resilience and adaptation space. So I would say the gap is narrowing massively, and I would just continue to see it narrow as we see what are increasingly interconnected risks and the manifestation of those risks across the world due to climate change. As a final point, as a climate scientist, we've always, all the risks to climate change, we've always taken a really conservative approach to those risks. And what we're seeing is when we move just past that conservative estimation of how those risks will manifest themselves, it's pretty scary. So I really do see a narrowing of the gap.
Great, thank you. Alex, some thoughts on that?
Yeah, I guess I'd start with sort of maybe there's three players who we should think about being at the vanguard of taking risk, and how we might think about doing that in a smart way. And there's the first group of people to think about are shareholders of multilateral development banks. The shareholders of the multilateral development banks often push sort of contradictory messages to the people who are on the front lines making investments and loans out of those institutions. On the one hand, they want a AAA credit rating. And on the other hand, they want them to push more into fragile states and more into difficult and emerging, and I mean that in the literal sense, markets that have to be built whilst you're trying to sell into them. There's a tension between those two things. If you are willing to accept a slightly lower credit rating, you'd unlock a bunch more capital. And so we need to start having those conversations at the highest level. The second is risk committees of development finance institutions, and getting comfortable having voices around the table that talk about trade-offs between social value and financial risk in hard-headed ways. So the better we are at measuring outcomes around resilience and adaptation, the easier it could be to have those voices be equally loud around the table at risk committees in DFIs, where right now the voice for impact often can't be heard at the same volume because we don't necessarily have numbers that you can really grab onto. And then third is the use of ODA, or traditional development assistance dollars, in this space to accelerate what the private sector can do. And one of the things that we can think about as a mandate there is not only, say, taking a subordinate position or blending your finance with others, but specifically thinking about getting companies ready to take on different flavors of finance. So when we engage with the private sector, doing it in a way where you're thinking about ESG, not just to protect taxpayer money, but because strengthening the ESG function of some of these companies is what will get them ready to be able to take on DFI capital. So I think that all three of these actors can be thinking very deliberately about getting that money, private money, off of the sidelines. How can we smartly use the public resources that we have to really drive towards that outcome?
Great, thank you.
Could I?
Yeah, please, Nate. Yeah.
Thought. So just to complement what Alex said, and it's really about this narrowing this gap of the risk appetite. I also think there's increasing awareness from the private sector on their vulnerability and exposure to climate change litigation. So we're seeing that a lot more these days, and I think we're only going to see a ramping up of that. And I think that also will drive or push them to increasingly look at reducing their risk appetite and investing in adaptation and resilience.
I hope so. I hope so. Let me come into another question here. That's a very interesting point about first loss capital and that sort of structure. And maybe actually, Andrea, come to you, because there's for a long time amongst the big corporates who seem to be leading in this space, there's a lot of pressure on them to say, well, look, it's great that you're investing in this yourselves, but can't you somehow open up this opportunity for others? Because there are simply not enough, companies with the size of balance sheet, with sophistication of a group like yours, in order to really know what needs to be done. So I'd be interested in whether Natura has had any sort of experimentation of public-private partnership, and if so, whether this kind of concept of the public sector trying to find a sort of a first loss capital slice that would somehow allow more private sector in on the back. Do you kind of buy that proposition? Does that seem like something that either you're exploring or you think is a replicable model for others?
I think it has to be. I love the idea. I don't know if structured necessarily in public-private partnership model, but the idea that you would allow for more people to understand what are the technologies that you're using, or what is the business model that you have, and then sharing that in either pre-competitive forums or through public policies that can amplify and enhance the benefits of that. So I'll take access benefit sharing, for example, or the Nagoya Protocol. Enforcing that across regions is outstanding. We have measured through our IPNL how effective that public policy is to protecting the ecosystem and to promoting improved social progress for the region, for the people, and creating more resilience. We can share that data. We can share the return on investments that we have when access to benefit sharing is correctly invested and used, and then how we're doing it. So I would say that definitely there is a space, and we're partnering with many initiatives. So even the Science-Based Target Initiative is a sector agnostic discussion in a way, and it will define methodologies for us to go forward in terms of how we're going to regulate carbon emissions, and how we're going to, well, not regulate, not in the SBTI, but how at least we're going to measure them and what will be valid or not. And other initiatives like the Ellen MacArthur Plastic Initiative. So I think there's many ways that you can amplify, share knowledge, and then accelerate the rate of change. And we should foster them all, really, in my view. If it has to be through a PPP, I don't know if that's the only model that you would have to do it, but I definitely am in very much favor of doing that. And
Great.
and I just one last thing I must say, although I don't know if we would call them PPPs, but in the Amazon region, everything that we've done in the communities where we've operated, it's always a combination of civil society, the government, and us, creating, and many times not just us, other corporates as well, creating the social technology that actually identifies the best way for reinvesting the money in those regions. And I think that's also very effective.
Thank you. Really, lots of insight there. Appreciate that. Let me move on. Let's go back to the barriers a little bit, because there's in these conversations, amongst a group of experts like yourself, we can always kind of whip up a lot of optimism, and we can think that lots possible. But I wonder if we could kind of turn to some of the simple stuff that we're not doing. And there was a great question in here on the chat about mangroves, which one of these solutions that seems really obvious, creates economic opportunity, stores carbon, creates resilience. Yet that's not taking off. And so maybe just on the specific issue of mangroves, which from all intents and purposes seems not a silver bullet for the entire solution, but pretty much a silver bullet in a localized sense. What are the challenges been there, and how does that reflect what some of these other barriers might be on implementing nature-based solutions? Nate, I don't know if you want to, or Alex, you want to try and tackle that?
Sure. Okay. Thanks, Alex. So just a few thoughts. I mean, I think mangroves do provide a really powerful, nature-based solution. As I mentioned, they kind of fit into that sweet spot of mitigation and adaptation. They sequester a lot more carbon than terrestrial forests. They reduce storm surge. They provide livelihood, security around fishing, and they're really a key coastal ecosystem. But you're right. I mean, there's still, I think there's one financial tool that exists today around mangrove insurance, and it's still in its infancy. So there's that. I think the challenge, relates back to what we were talking about earlier, which is really recognizing the value of these coastal ecosystems and recognizing the value of mangroves. Now, there's been a lot of studies in the last 2 years that have actually highlighted those values. And I mentioned some of those numbers before, but I think as we see these climate risks emerge, and we're seeing sea level rise, increase, then we're starting to see, further investment into mangroves. And I sit on the leadership team of the Ocean Risk and Resilience Action Alliance, and we're certainly seeing a lot of private sector interest into mangroves and also into, things like blue carbon resilience credits, into things like, even coral reef insurance that looks to clean up reefs after significant storm events, and that enables them to recover and be functional into the future. Absolutely the barriers are still there, but I do see it shifting, and I think you have to be an optimist, if you want to be working in this space, because that's a necessary sort of mindset. But I would still say that overall, that I hope that shift will continue to gather pace as we see sort of climate risks increase and an awareness of those climate risks increase. And there's a lot being done on understanding those climate risks from a lot of really smart companies out there, and also from the public sector as well.
Nate, can I just follow with you on one question there? I had in the late 90s, had the great opportunity to study with Robert Costanza and Herman Daly, who were some of the first people to really put out some of these numbers on ecosystem services and the valuation of them. How important do you think that is now, that continues to be refined? Or was it really, how much do we need to value the stock first before we can move on to the kinds of things you just mentioned?
So I think it's still critical. I think it's sort of a challenge of the resiliency of the existing system that requires that we do that. And it would be great to break sort of, some resilience we want to break and some we want to build. And I think it would be great to break that resilience, but I don't see that happening in the short term without a really significant shakeup. So I do see that economic valuation of nature-based solutions and of ecosystems, both terrestrial and coastal, and ocean for that matter, as critical. I think the valuation has really become a lot more sophisticated, especially over the last few years, as people recognize those risks. And I think that's where I get excited, because now you can start to take those numbers to investors, and they stand up to the questions, and and they're robust enough that investors have confidence to work with them. And as I say, insurance companies really leading the way in this space.
Super, thank you. Alex, could I come to you, and whether it's mangroves or something else, what does the lack of scalability in some of these quintuple win situations mean for, or what we need to do better and what we need to do next?
Yeah, maybe I'll just reflect on how we might conceptualize public-private partnerships in a more generous sense with one example, which is, it was a recent push, I believe it was in Mali, to pay smallholder farmers to avoid deforesting on their land, and including just reducing the density of the forest cover. So trying to take on both collection of wood for fires, et cetera, not purely just cutting down trees. And these payments were designed to be sufficiently generous that it should have compensated the average farmer more than the typical amount of logging that they would have done in a given year. And also, they were able to renege on this. So if in the course of the year they decided, in fact, they did want to cut down some of the trees, they were able to do so. And what happened in that case? A really disappointing level of take-up and a real failure to scale. And in this sort of ex post examination of what was going on there, and did these farmers understand what was happening? Perhaps it hadn't been explained well enough, et cetera, et cetera. In fact, it came out that they understood very well what the deal was, and they were acting from their perspective entirely rationally in declining to participate in the program, because the ability to cut down trees is part of how you established property rights in a context in which formal property rights systems are really lacking. And so to really think about scale of a program like that, you needed to be hand in glove with a government that was willing to do the work to help formalize what those property rights were actually going to be. And now there's all kinds of innovation that could make that easier from both perspectives, both in being more sophisticated about what your payments should look like and how they should be done, but also in using remote sensing and other new techniques to do a better and smarter job at setting what those land rights are. So I think, it's a great example to me of scale is about getting the market and the business model right, but it's also getting that government, what you do need from the public sector right as well. And so we've got to join these two things up.
Can I build on that?
Of course.
I thought this is like an exceptional example of sometimes we don't understand why certain things just don't pick up. And it usually is because there are barriers to implementation that actually, or that are counterintuitive to what the original intention was. So we've experienced tons of examples like the one that Alex just shared in the Amazon region, where all the way from land security and those rights, as well as how do you reinvest in the region in a way that you don't concentrate in one family, or you don't how to do that. So and yes, the public mechanisms are critical for facilitating or hindering the implementation process of these things. They're absolutely critical. So identifying these pain points and then working with governments to release them and to redevelop them, as well as implementing new technologies, like she said, that could, offset whatever it was that led the legislation to be like it was, to me is an excellent example of how you can accelerate things that we know are good to do, but that just don't get done.
And Charles, can I jump in for 1 minute?
You bet.
Great, thanks. So just to build off that, I would say, so absolutely, just speaking on the locally led adaptation and Alex's point, we also have to remember that Indigenous people represent about 5% of the global population, but they steward about 80% of our ecosystems. So we really need to focus on them and having them as sort of key leaders of these solutions. And then I would say, on this point, on Alex's point on sort of identifying these levers, and Andrea emphasized it as well. I think with resilience and adaptation, we have to embrace the complexity. So there's a tendency when we look at problems to sort of narrow them down, focus really in. But when we're looking at resilience and adaptation challenges, we really need to sort of almost widen out and say, where are these things connected? Let's lump these things together, and then we can find much more scalable solutions.
Good. We're coming up almost to the end here. So let me ask one kind of concluding question for all of you. And I'll just say, just flag though for Alex, there was a question that Hao Tan asked that's probably best for you to follow up kind of individually. But there was a question that Simon's asked that I think more broadly speaks to something you all, I'm sure, have a view on, which is who should be doing this coordinating work? Where, there's a suggestion here that the G20 should be doing more. I'm sure we could make a case that the World Bank, the IMF, that all sorts of business councils. So maybe just share your thoughts with us where the action is really happening in terms of that coordination function at a very, very top level, and who should we be pushing on in order to really make this happen? And maybe Alex, I could start with you on that question.
Thank you. I'm just thinking a little bit, everybody always wants to be the coordinator and nobody wants to get coordinated. So, it's sort of a classic challenge. And I think we're also balancing this with, the really nice point that Andrea made earlier, which is decentralized solutions might actually be the way forward. And I think there's some lessons for that for the policy world too, that it's unlikely that there's a single place to come together. And instead we need to be much more fluid in terms of thinking about when coalitions form and dissolve. We're certainly, as is with any global public good, those moments like Paris, when you come together, are very precious, and maybe are the exception to the rule. So I think I don't think we have one single answer to that question. And instead, we need some common language so that these fluid groups that come together and go apart, can actually talk to each other. So whether that's coming back to Nate's point around measurement, so that we can talk in an apples to apples way about things, or Charles's point in the comments around ESG and what is that going to mean? And we need it to mean the same thing at Davos as it does in the boardroom, as it does, at a place like Global Innovation Fund. So maybe that's not the most satisfying answer, but I think I'm tending towards that decentralized vision myself these days.
Good, thank you. Andrea, could I invite you to reflect on where are the levers of power here that we all should be trying to influence?
I agree with Alex. I would go decentralized. I think that to me is the mindset shift, the most important mindset shift we need to embark on, which is this idea that, and it is connected to Nate's point on complexity, embracing complexity and understanding that we should be working in networked systems, maybe even being inspired by biomimicry and how nature connects and decentralizes in these networks that actually have a common language, that have effective communication systems, but really produce the solutions on ground. And then what you need to do is you need to maybe ensure that you're making these solutions become viable by getting the investment there on time at the right place and sharing the solutions. But I agree with Alex, I would go decentralized as well.
Great, good challenge. Good challenge. Nate?
Yeah, thanks. I would be foolish to disagree, but no, I think that is absolutely the way to go. And maybe I could just pick up on a few of the comments that are springing into the chat as well. So I do think the point around the lack of the common language here on climate change, I think that's partially driven just because of the size of the crisis and the amount of change that will be required to tackle it. So there is a sort of lack of common language, but there are opportunities. I think as much as I can be cynical, while I try to remain an optimist, I can be quite cynical about some of these political convenings. Do think the COP is a really key opportunity to bring some of that common language. And I think as we increasingly see these risks reverberate around the globe and impact us in ways that we had no idea or couldn't really even imagine, we will see more of a common language and more of a common approach. But certainly the decentralized approach is key. And just touching on the point on infrastructure as well, that really the critical lack of infrastructure, including early warning systems. I think that climate resilience infrastructure is absolutely a key focus for hybrid financing models into the future and needs to be addressed, including early warning systems. And there are some great partnerships like the REAP partnership out there that are approaching that.
Great. This has been a fascinating discussion. I'm sure we could go on a lot longer. And there are still some questions there. So I'm sure the Conduit's got some way of connecting you all, and hopefully that can be in person in someday soon. So let me just a couple concluding thoughts. First, to thank the panelists for taking their time to share their ideas and their thoughts, and also to the Conduit for organizing a really nice panel. I think this has been we all get invited to do these things, and you have some hesitancy, and so I'm really pleased that it was as rewarding as I thought it would be. And just in conclusion, I just want to, there was a question that we didn't get to that Theo asked about, is this that people just don't understand? That fundamentally they don't see the value somehow. And I want to offer that I think that it's actually a lot more than that. I think it's actually speaks to the way in which that value is just simply not shared across all different participants in the chain. And so I was really reminded of that last week in reading an editorial by John Cochrane, a former Chicago professor who's now at Stanford, in which he wrote about the fallacy of climate risk. And while I could make a very coherent, rebuttal, what it reminded me is that there's still a lot of people who are not on board with this. And as the further that we go, it seems, in terms of the depth of the conversation, every once in a while, we jerk back to a realization that not everybody is left from the same starting point. And so again and again, we kind of come back to those starting points and try to build in a stronger way. But I think that the barrier that we continue to face is that while we can see value from a shared perspective, we have a system, an economic system, which tries to compartmentalize and monetize that for individual gain. And until we find some way around that, we're going to be constantly blocking into a situation in which we implore and we say what people should do, but we don't really find a way to change that situation. And for all of the stuff that we've heard today, I'm really encouraged by. But I know and tempered that optimism with a sense of worry that we still don't have an understanding of how not to measure and monitor. We can do all those things, but actually to find a way in which the enlightened self-interest of investors to create financial return for themselves is fundamentally shaped by the necessities that we've been talking about here. And we are still living with a lot of old ideas about what investing is, full stop. And it's been my mission coming into academia to try to change those ideas so that we can at least put out business leaders who don't unlearn what we teach them, but learn hopefully the right things the first time. And so we've all got a long way to go. So that optimism I share every once in a while, needs to be, I think, also tempered with an awareness that we still have not got a lot of people with us on this journey, and they seem to be several steps back. And I hope that we can change that situation for the better. And I hope that conversations like this will be part of it. So let me thank you again for your participation. Thank you to the folks who joined us, and wish you all the best with the rest of your day. Take care.